We're good? Okay.
Yes, we are.
We're going to go ahead and call the meeting to order. It's 9:05. I'll ask Amber to take a quick attendance so we can declare a quorum.
Sure. Ava Bermuda Zimmerman. I do not believe Ava has joined us yet. Isha Canada.
Present.
Thank you. Adrian Cochran.
Present.
Carol Duzinski.
Here.
Josh Jabal. I don't believe Josh has joined us this morning. Nope, not yet. Sal Luciano. Sal is not yet with us. Alex Marcelino.
Is joining right now.
Perfect. There we go. Great. Good morning, Alex. Paul Patamianos.
I'm present.
Fran will not be joining us today. John Scott.
Here.
Mike Soltis.
Here.
Molly will not be joining us today, and Justin Zartman.
Here.
Thank you.
So we
And
have a
quorum.
quorum, so I'll go ahead and declare a quorum, and I'll acknowledge that we have Senator Kushner here, and also thank all the other guests that have joined us today. The next item on the agenda is approval of the October 14th meeting minutes. Is there a motion to approve those minutes?
This is
Motion to
Paul.
approve, Daryl.
I'll second.
Yes,
This is Paul.
All right, so we got a motion and a second. Is there any discussion? Hearing none, all those in favor?
Aye.
Aye.
Okay, opposed? Abstentions? That motion has carried. All right, so the next item is the presentation of the audited financial statements for the period ending June 30th, 2021. So I'll invite the Marcoon team to provide us with a presentation of the audited financial statements. So who is that?
Thank you, John. Thank you, everyone.
Sorry, Chris, before you begin, John, can we acknowledge Representative Porter, who's also
Oh,
on?
yes. Welcome, Representative
Okay.
Porter. I didn't see you come in. Welcome.
All right, thank you. Thank you, Chris.
Thank you, Andrea. Damien, can you share the slides?
Yes, can you confirm that you're seeing them?
Yeah, if you could run it as a presentation, that would be perfect. I think we've got the notes there. Excellent. Thank you. And thank you, everyone, for the opportunity. I'm Chris Jackson. I'm the audit partner on the audit of CTPLA. I'm joined by Damien Kogel, who's the director here on the audit. We work together as a team with Andrea and the finance team to work through and perform the audit. We're pleased to present the results this morning. I believe that you're provided with the audited financial statements in advance of this meeting, as well as the presentation that was made to the Finance and Audit Committee on October 22nd. On that date, we did spend about 30 minutes going through these financials in a lot of detail. And today, in the interest of time, we plan to make a higher level presentation and certainly allow for questions at the end of that presentation. So if we jump right into the slide deck, the first slide really just goes through the points we're going to cover, then we'll jump right to the background information, again, in the interest of time. We'll start with just giving some information about overall where CTPL falls within the hierarchy. In the GASB hierarchy, under GASB 4, CTPL is considered to be a fiduciary component unit of the state of Connecticut. So that is how you're designated within these financials and within the state system. So that was an area of focus. We worked with the state comptroller's office just to make sure that we're all in agreement with your presentation and everyone is in agreement with the way that these financials are portrayed, and will fall right into the state auditor's report when they issue their report on the state of Connecticut. Here, we've just got some points for background, just to give you an indication of the timeline of when CTPL became an operating entity. And that really just helps you to put things in perspective as it relates to the audit period. Because we've covered the 18-month period ended June 30, 2021. And the reason for the starting of the audit period in January was really just to get the full 18 months of activity. And that's really when the operation started. I know that the entity was formed legally prior to that, but the operations really started in January. So that's just for a point of reference why some of this information is here. In addition to the audited financial statements, the annual report that was presented to you or provided to you also includes management's discussion and analysis. And that provides additional background information about CTPL and the related public act itself. So there's some good information in there. It also provides some highlights on the 18-month activity and also provides an outlook for fiscal year 2022. So I encourage you to read that if you haven't done so already. And I just want to point out that our audit opinion does not extend to management's discussion and analysis. We're only required to perform limited procedures on those steps, and it's not possible to basically audit the outlook for the upcoming year. So just as a disclaimer, that is included in the annual report, but that was not audited by Markham. We move to the next page. We'll talk a little bit about the audit report itself and the opinion. This slide just describes the fact that we have issued an unmodified audit opinion, and that is basically a clean opinion on the financial statements. And that's the highest level audit assurance that can be issued. So that's all positive, and that's due to the great work of the CTPL team. Things were all in balance, and we had no issues as it relates to that. So we had an unmodified audit opinion. The second report that we issue is a report on internal control over financial reporting and on the test of compliance with provision laws, regulations, contracts, and grant agreements. So it's basically looking to see if you had any material weaknesses, and we are pleased to report that there are no material weaknesses at CTPL as it relates to the internal control over financial reporting, and also as it relates to compliance with laws, regulations, contracts, and grants. There are no instances of non-compliance detected. And again, these are the highest levels of assurance that can be provided, and these reports are issued in accordance with the American Institute of CPA's reporting framework. So again, it's not exactly saying that there were no material weaknesses. There were none detected, but in theory, there could still be material weaknesses out there that were not detected. That's really what the framework says, that none were detected during the course of the audit. So Damien's going to walk you through the next couple slides with some financial highlights, and then we'll open the floor up to questions if there are any.
Thanks, Chris. So I wanted to cover just some of the financial highlights related to the statement of functional net position. We wanted to start with our current assets. That's on the books at $209.4 million, primarily driven by investments of $101 million and contributions receivable of about $99.3 million. Your current liabilities on the books were around $626,000, and this really puts the authority at a very strong current ratio position. It's a financial net position that any organization would want to have. The statement also includes capital assets of $6.8 million, which were primarily related to computer software being capitalized for the running of the organization. The non-current liabilities of $18 million primarily relates to bond and seed funds that were received from the state as a startup for the organization. However, those amounts will be paid back to the state over the next couple of years. That's further disclosed in the financials as to the payment of those funds. The pension and OPEB liabilities of approximately $700,000 were actually determined based on actuaries were hired by the state to determine the authority's proportionate share of those respective liabilities. And that also includes a deferred outflow of resources that resulted from contributions made during the year, during fiscal 2020, compared to when the actual calculation was done as of June 30, 2020. So it's a 1-year delay, which resulted in some deferred outflows of resources being brought on.
And OPEBs refer to other post-employment retirement benefits, primarily health and life insurance. Just for point of reference, I know it's an accounting term that not everyone on this call may be familiar with, so I apologize for if we glanced over that, but that's what OPEBs relate to. Sorry, Damien.
No, absolutely no. Thank you for pointing that out. The next slide talks about the statement of changes in net position. And here for the authority, it primarily relates to contributions that were received from the participants And just a point of reference, these contributions started in January of 2021. So this really represents 6 months of contributions that were received during the period of being audited. The next section just talks about the deductions that where the funds, some of the funds were used. I won't go into much detail as they're pretty straightforward laid out here. And the ending result is a net position of 198.5 million that is in your net assets or your net position that's restricted for the payment of benefits to the participants once they start submitting claims in January of 2022. The final slide that we wanted to cover is just other communications that we wanted to generally talk about as part of our presentation. And just to emphasize the fact that there were no material unrecorded adjustments. We worked with management being the first year to ensure that the pension and the OPEB adjustments were appropriately recorded once the information was received from the actuaries. And we just worked collaboratively with management just to make sure that there were no missing pieces to the financial statements, both in the disclosures that were presented in the financials themselves and any adjustments that were to be recorded. Management did a good job of capturing everything, and then Markham reviewed those or tested those to make sure that there was nothing missing. We noted no instances of fraud or illegal acts as defined by our auditing standards that would have directly or materially affected the financial statements. With that, Chris, I'm not sure if you wanted to add anything, or we can open up to questions if anyone from the public has any.
Thank you, Damien. Very good presentation. I just want to also just remind you that the management's discussion and analysis on pages 3 through 7 of the annual report really is a good source of other insight behind the numbers in these financial statements, gives a lot of detailed information, and also talks about the resources of CTPLA and also talks about the future for 2022. So I encourage you to read that if you haven't done so. And certainly we'd be happy to answer any questions you may have on the financial statements at this time. We did spend about a half an hour with the Finance and Audit Committee, but certainly if the full board has any questions, we'd be happy to answer those, or management can respond to those as well. Our contact information is here. It's also in the audit results report that was sent out to you as well. So feel free at any point in time to reach out to Damien or myself, or through Andrea and the rest of the management team at CTPL. But certainly, thank you for your time this morning. I'd be happy to answer any questions you may have for us.
Are there any questions? Hearing none, thank you, Christopher. Thank you, Damien, for all your hard work.
Great, thank you. Thank you for the time this morning.
All right, the next item on the agenda is presentation of findings of the updated actuarial analysis. So I'd like to invite IWPR and WildFig Partners to provide us with findings of the updated actuarial analysis. So who is up?
Good morning, Mr. Chairman and members of the Paid Leave Authority Board of Directors. My name is Michael Wargetz with WildFig Partners. I'm leading the presentation on behalf of our project team. Jeffrey Hayes of the Institute for Women's Policy Research conducted the benefit utilization analysis. Jeff is here today and will participate as needed. Our policy analyst, Samantha Roth, is also in attendance today. Slide 2 has the overview of, Samantha could go, yeah, there we go. Since last year, we learned a lot about the actual effects of the pandemic on FMLI programs, claim volumes, collections, and other variables. So I'll begin by reviewing updates to the 2020 forecast. Importantly, the forecast includes 2 benefit utilization scenarios: and anticipated, which is the expected level of activity, and high utilization, that is more claims and higher payouts than expected. For each scenario, we offer alternative forecasts if benefit rates are adjusted from what is in current law. This was done to be thorough and for informational purposes, not because such action was expected to be necessary. We know you are on the edge of your seat, so the next slide has an executive summary of the key takeaways. The key takeaway here is that the forecast is positive. The trust fund remains solvent in each scenario that we ran. Revenues exceeded expenditures over the 5-year time horizon of the forecast. There is time to wait and see what the actual outcomes and trends are. Moving on to slide 4. We were able to analyze a lot of important data and trends over the last year, especially related to claims activity in other states and the labor market. The authority also has more precise administrative cost information. The current analysis more directly addresses the impact of increases in the state's minimum wage on benefit costs and revenue collections. This analysis includes detailed benefit utilization scenarios for anticipated and higher than anticipated claims activity. Washington State's experience during their program's recent launch is the basis for the anticipated utilization scenario. Recent experience in the legacy states of California and Rhode Island is the basis for the high utilization scenario. We also generated sub-scenarios, if you will, with adjusted benefit rates, which I'll address later. The table at right summarizes the updates. Slide 5 compares total claims filed under our 2 scenarios for the program's first year of benefit payments. The chart on the right shows, on the left shows the breakdown of the 83,900 anticipated scenario claims. There are about 10,300 more claims expected in the high utilization scenario. These totals account for an anticipated 7.4% uptick in year 1 claims based on Washington State's year 1 experience. This is a one-time phenomenon. Year 2 total claims are expected to be lower than the year 1 total. As I mentioned before, Jeff Hayes of IWPR is here today and can address any questions related to the claims analysis. Slide 6 shows the fund's projected fiscal activity with anticipated utilization. On the next slide, we'll see the high utilization scenario. The same revenue forecast was used in both scenarios. Actualized revenues to the fund are forecasted to total $425.5 million in calendar year 2021, increasing to $570 million by 2025, which is a cumulative annual growth rate of about 7.5%. Projected growth in revenues is predicated on a gradual decline in unemployment over the 5 years, as well as wage growth assumptions provided by Connecticut's Office of Policy and Management. On this slide, we see expenditures exceeding revenues in 2022 and 2023. This is due to first-year benefit costs being higher and implementation spending as well. But revenues are projected to exceed spending by 2025. In this scenario, the trust fund's balance decreases initially, but stabilizes and grows by the end of the forecast period. Slide 7 shows the higher than expected utilization scenario. As I mentioned earlier, the anticipated utilization is based on Washington State's recent experience launching a similar program. The high utilization scenario is based on California and Rhode Island, 2 states that have had FMLI programs for years or decades. Both scenarios factor in recent experience during the pandemic. The key difference on this slide compared to the last one is significantly higher benefit costs, which drive total expenditures higher than revenues in all years. Accordingly, investment income to the fund will be lower, and a year-over-year decline in the fund balance will result. Nevertheless, there are some positive takeaways here. One is that This is not a picture of insolvency. The ending balance in 2025 is still projected to exceed 150 million. A second is that revenue growth is faster than expenditure growth. Looking at the right side of the slide, the graph shows revenues closing in on expenditures by 2025. Still, the year-over-year decrease in the fund's ending balance warrants close attention and may prompt some contingency planning down the road. The following slide offers some insight into how this can be addressed in the future, if necessary. Slide 8 shows the ending balances of the fund under both scenarios, presented with current law benefit rates as well as benefit rates adjusted lower by an incremental and a full step. The current law benefit formula specifies wage replacement of 95% wages below a certain threshold and 60% wage replacement above that threshold, capped at 60 times the minimum wage. The incremental and full step adjustments lower the wage replacement rates and the maximum benefit rates as shown at the top of the slide. The 2021 year-end balance is the same under both scenarios, as claims won't be paid until 2022. Claim activity in 2022 results in a dip to the fund balance with the current statutory rates in place. The solid line is what was presented earlier. The dotted lines show balances in the fund if benefit rates are adjusted. The high utilization scenario plays out similarly, but the decrease in the fund balance is protracted with current statutory rates in place over the 5 years. Still, both pictures show a fund that can withstand the unexpected and is likely to be stable, if not growing, by the end of the 5-year period. If it's higher than expected utilization, and if that does in fact lead to a declining balance, there are mechanisms that can be put into effect. It is important to emphasize that this forecast allows the state the luxury of time to see how trends develop. If actual experience leads to undesirable trends, planning may begin in 2022 or 2023 to make adjustments. Our final slide recaps the key takeaways and repeats the bullets listed in the executive summary. I want to thank the board for the opportunity to present today, and to thank Andrea and her team for the opportunity to engage with the authority on this important work. With that, I'm happy to answer any questions.
Hi, Michael. This is John Scott. This is a conversation that came up during the Finance Committee meeting, and I feel like I need to bring it up again here. The slides that have the closing balance numbers on them, I think it was like 6 and 7 for the high and low utilization. It's a number that's striking to me in the sense that, you know, we're extracting a pretty significant amount of money from the Connecticut economy. And I think this is something that we as a group need to be paying closer attention to. I mean, if we have anticipated utilization, we're going to have a savings account with $357, almost $358 million in it. Am I reading that correctly?
That is correct.
And then even in the worst case scenario, we'll have a savings account with 155 million in our savings account. It bothers me as a taxpayer. It bothers me as a former small employer that we're pulling this much money out of the economy. Now, it's hard to predict what things are really going to look like, but I think this is something as a group we need to be paying attention to, and maybe the percentage that we extract as a tax needs to be looked at more frequently. It's a lot of money to be pulling out of the Connecticut economy. Just my 2 cents.
Yes, these types of funds do tend to carry large balances. It depends on a lot of factors. Depends on the size of the state. For instance, in Rhode Island, the balance is routinely $90 to $110 million, depending on the month. Larger states will have larger balances. It's certainly an important policy and fund management decision to make The only point that I would add is it's still very much a forecast at this point based off of other data sources than the ideal. The ideal would be actual history in the program. So it's definitely something to watch closely.
How can we turn something like this into a more active document once we start paying claims? How do we use this to track how we're doing and start making some forecasting of our own in the future? Again, with the idea that maybe we can lower that tax.
Well, that is probably the most important thing to do. I mean, the initial forecast is something that is critical to develop, and then I think the real, it's sort of like then the real work begins. But I'll say that the real work is more about keeping up with it. There's not as much heavy duty analysis involved once this part is finished, in my opinion. It's more about managing and tracking. A more active way of doing it, I think there are different programs out there that could be used, or it would be a decision of for you all in the authority to decide how you would want to go about doing it. But the most important thing is just routine sort of review of actuals against projections, and sort of fine tuning the process.
John, I just want to jump in because Michael, I think Michael did give us a tool that we can use, right, that our finance team will be using. It's fairly sophisticated spreadsheet, just not to simplify it because it's a much more sophisticated tool than that can allow us to track the spending, and then we can track it against these projections that they've made, so we can know almost on a real-time basis where we are. So we do have that. And we've already twice issued an RFP for an actuary that can do a more in-depth analysis, but I don't know if we're not going to the right places because we've not received a response for these last two. So we're going to try it again, going to maybe some trade associations and some other places where we can go, because we've been looking for it at least the last 6 months for an actuary to do that work. But the tool that they provided us should allow us to be able to do this until we can get someone on board. So there will be monitoring. I just wanted to let you know that.
And I appreciate that, Andrea. Okay. My last question with respect to these closing balances, is there a industry standard or a best practice as to how much that should be? As far as maintaining our solvency, if we were to change our percentage in the fiscal year 2025, let's say 50 million instead of 150 million, is that the difference between, insolvency at a future point? I mean, I don't know if I'm stating that question correctly, but that's just my thought.
You are. So go ahead, Jeff, because I was
to say, I think it's most states are trying to maintain a 25 to 50% balance. It's about 25 to 50% of either 1 year or 6 months. It varies. Each state has their own formulas and their own way they monitor it, but about a 25% to 50%. So at the 155 level, you're actually getting, in that ballpark range. At the other higher level, you can. Again, for the program and for these forecasts, we have done you guys in your law have the maximum withholding benefit of 0.5%, which is, again, it's pretty in line with the other states, but it's a maximum and not a start. It wasn't really, so going down, it's also something that you and the management and the board can decide to do. But again, because I think everyone thinks that's good if the management team sleeps at night, you start at the high level. And so that's why we were trying to stress test this, is that things are looking pretty good, even at the high stress levels. We did do the analysis of the worst way to go. Instead of, we were always being on the negative side, trying to look at what if things went wrong. If things go right and you can cut that tax, I think that, everyone would be on board with that. Once it's your own data, once you think things have smoothed out and, employment is all back to where it should be and things like that.
The other thing I would add is, and that's right, some states run between 25 and 50. I think Washington's just a little bit higher, but they all also have different funding mechanisms too, which is what we're trying to keep in mind. So because we have the one source of funding, which is the 0.5% that people contribute to the trust fund. Some states have employer and employee contribution, and some of that is on a sliding scale. So I think that from the management perspective, we'd like to see how things go this year and then be able to come back to the board with some information about what the actual utilization is, as we have models for anticipated and high, but we don't have any models for actual. And then be able to have that data and then just have a conversation about what might be feasible for us to do. So I mean, when we go out into the community, either virtually or real, we hear three things that people are concerned about. One is that people use the fund in the way that they should, which includes people not engaging in fraudulent behavior. The second is just sort of a general philosophical differences about whether or not we should have paid leave, right? And the third is solvency. Those are really the top three. So if we can just wait a bit and determine how things actually go, then I think we can come back and have a more educated decision about what would be the right thing to do.
And I agree with those comments, Andrea. I'm just wanted to get in the record the conversation we had at the committee level that I have some concerns about the amount of money we're extracting from the Connecticut economy that just goes into our savings account. So, and I'll shut up now, but I just wanted to get that into the record.
Understood. Thank you.
Are there any other questions? All right, we'll move. Thank you, Michael, and your team for helping us out with that. I very much appreciate the conversation today on that one. Do we need to vote on that? So the next item is discussion on comments received in connection with the private plan policies and a vote to adopt private plan policy documents. So Michael Cesar, our Associate General Counsel, is going to give us a presentation on that. Michael?
Okay, so I'm going to do this instead of you, Aaron.
Yes,
I have my notes at you,
Okay.
Michael.
I think everybody knows but you. Sorry about that.
No problem at all.
Better up.
Surprise. Yes. In the
It's life
grand
in
scheme,
startup land.
I'm just thinking in the grand scheme of unaccomplishable tasks, there's like counting stars in the sky, counting grains of sand on a beach, and filling the shoes of Aaron Choquette is got to be up there in the top three. All right, let me share my screen. Can everyone see the Excel document?
Yes.
Okay. excellent.
Yes, if you wouldn't mind zooming in for those of us who have aging eyes, that would be greatly appreciated. Thank you.
That's probably too far. Does this work? Awesome. So as the board knows, at the last meeting, we published for notice and comment the private plan policy documents. There were three documents. There was the policy and procedures document, which is sort of an end-to-end, how do I go about establishing a private plan? What sort of overall rules do I need to follow? There was a policy filing guidance document, which is for employers who are utilizing an insurance policy, kind of a guidelines about what that insurance policy should look like, what provisions need to be included, what the rules are around those provisions. And that's going to be helpful for when they file that with the Connecticut Department of Insurance. And then the third document was a checklist, which is sort of that second document in a condensed form. Helpful to when they file it with the insurance department, allows them to indicate on which pages they satisfy the various requirements that are in the policy filing guides. So those are the three documents I think we are looking for comments, questions, and eventual approval for today. There also is an additional document that was shared, which was a self-insured policy template. Basically, for those employers who are kind of going on their own, not using an insurance carrier, or using a less sophisticated TPA or someone like that, it's a helpful document. Here's what we want the policy form to look like when it's self-insured. It's, kind of a sample document with some rules built into it that it should be helpful for any employers who aren't using a carrier. So we posted those comments or posted those documents. We did receive comments. The window, I think, closed about 2 weeks ago. So Aaron and I have been going through the past couple of weeks, the comments, deciding what we agreed with, felt needed to be changed, what maybe we disagreed with and didn't want to change. And so I'm just going to take a moment to go through each one of those. I know we have a pretty busy schedule, so if I go through this really quickly, I apologize. Feel free to stop me, or we can wait till the end and I can answer any questions or provide any clarification, or maybe you can reconsider any of the decisions we made. So the first comment was around other income that the employee receives at the same time that they're receiving paid leave benefits from the authority, or actually from the private plan. The idea was we wanted to make sure that if the employee was receiving their full pay from their employer through accruals, and therefore they weren't eligible for CTPL benefits, those days wouldn't count against their 12 weeks accrual allowance. If, on the other hand, if they are receiving both at the same time, supplementing their CTPL benefits with accruals, still under that 100% of their normal pay, those days would count. So we just wanted to identify that. And I think there's a question about whether those days should or should not count when they're not getting their full CTPL benefits. We're saying because they're getting something from us, those days do count. The second item on the list is very similar. It's just clarifying when we're talking about supplementing CTPL with other income via accruals, or when we're substituting. So supplementing versus substituting. We want to make sure we clarify that. So we did make a change to the documents identifying that. The next item was about the requirement that employees utilize accruals because CT-FMLA does allow employers to require the use of accruals when an employee is on leave. We asked for that to be in the policy, whether the employer does or doesn't require it. So we did receive some feedback at saying that because that's an employer-employee conversation, it shouldn't be in the insurance policy because the insurance carrier is not really involved in that decision. While we do understand that, we also think that from an employee's perspective, this document should kind of give them an idea of what they're supposed to be doing when they file a claim. So even though it's the employer's decision, we ask that the insurance carrier or TPA ask the employer what decision they made and identify that in the document. So it's all in one place for the employee. This next item is just a comment about our statement about when the CTBL benefits are reduced for other income they're receiving was pretty broad. So we did add language identifying exactly when that other income could cause the benefit to be reduced. In this case, it's when it would cause the employee to receive over 100% of what they normally would be paid prior to the leave. The next item was clarification that while an employer can require an employee to utilize their accrued time, the employee is allowed to retain at least 2 weeks of that accrued time. However, that only applies when the leave is subject to Connecticut FMLA. So we did add language clarifying that. So in other words, when the leave qualifies for paid leave but doesn't qualify for the job protection under FMLA, then an employer is allowed to make an employee utilize those last 2 weeks of accruals that they may have. So we did identify that in the policy. The next item is in relation to both reductions due to other income or exclusions and inability to receive benefits when an employee is receiving other income, for example, workers' compensation or unemployment insurance. So the request was that we add a phrase that the other income applies only when it's due to the same leave reason or for the same period of time. We do agree that it applies only for the same period of time. In other words, you need to be receiving paid leave and this other income for the same week that you're on leave. However, we disagree with the idea that it must be for the same leave reason. In fact, when it comes to like unemployment insurance, the leave reason is totally different. You're receiving unemployment benefits because you're not working and you don't have a job to go to, versus you receive CTPL benefits because you're unable to work, not that you don't have a job. So we disagreed with half of that, but did agree with half of it. Next item is just technical. There was a couple times we referred to covered employees, sometimes capitalized, sometimes uncapitalized. We did fix all of those so they're consistent throughout the document. We received a request to indicate contact information for an employee when they decide to file an appeal or reconsideration with the Department of Labor. And they asked for that contact information to be in the policy document. We disagree with that for two reasons. One, we don't actually have that decided yet. We're building the system for that appeal. So we will have that when the system's ready. And then secondly, we didn't know if this necessarily had to be in the policy document. As long as when a request is denied, the employee gets that information on how to file the appeal, that should be sufficient. And we'll obviously have that before claims start to be approved or denied. Next item was around the time frame between approval of the private plan versus the effective date. We did build a rule that in order to be effective at the beginning of a quarter, the approval for the private plan must happen at least 30 days prior to the first day of that quarter. So as an example, if approval is supposed to happen, or if the plan is supposed to be in effect January 1st, approval of the plan must happen by December 1st. The next item is very similar. This one is about for the filing of the actual documents. We have some people with provisional approval during 2021, where they just basically applied for the plan, but we hadn't yet built the rules around what the plan needs to look like. So eventually we need to get all those documents and that official approval. We are saying 30 days from the publication of these documents that we're asking the board to approve today. So likely will be December 10th. However, if there's some sort of delay, we need to talk more, make some decisions, might be 15th or later date. The next item is in relation to former employees. As everyone knows, the statute does require employees to continue to potentially receive CTPL benefits up to 12 weeks after their employment ends. So there was a request on the private plan side for an exclusion to that if the employee leaves a private plan but then becomes covered under a similar program somewhere else. It can basically shorten the 12-week window. We didn't think that was correct according to the statute. We felt like if an employee, for example, if an employee is employed in Connecticut under a private plan, leaves the state and takes a job somewhere else in a state that has a similar paid leave program, we didn't think the statute allowed us to say that 12 weeks doesn't apply any longer. They potentially would be covered under two plans in that circumstance. And really the safeguard is they can't receive benefits under both. It's kind of at that point potentially up to the employee to decide if they want to file a claim under CTPL or file it under that separate program. But we didn't think the statute allowed us to say, because you have this potential somewhere else, we're going to say you can file, you're no longer covered under the CTPL. So that applies both to the public plan and to private plan. So the only exception we can think of is if you're under a private plan and then you get CTPL coverage with a different employer. So you change jobs within the state of Connecticut and are still eligible under that plan. As I said, I apologize, I'm going really fast through these. I just know we have a lot of stuff on the agenda. The next item was just a very technical one about one of the requirements we had was a version number on the policy forms, and clarifying that that's different from the form number. The form number is what kind of gets filed with the Department of Insurance and is the same for every employer that carrier has, versus a version number, which is each individual employer, if they make changes to their plan, there's a version 1 that's in effect for say 3 years, and then a version 2 that's in effect for the next 2. So just indicating that those are 2 separate requirements. The next item was feedback we received around the requirement that employees, when a claim is foreseeable, provide at least 30 days notice to the authority or private plans, of that need for the leave. Basically mirroring the same requirement that exists on the job protection CTFMLA side. So we did receive some feedback that was perhaps a little harsh, and that we should provide a lesser period of time that the employee has to submit the request for leave from us, or less for request for paid leave benefits from the private plan. We understood that feedback, but we felt like it was probably better for all parties involved if the same timeframes apply. The employee's already getting their paperwork together, submitting their documentation to their employer for the FMLA. So it seems more efficient to have them do the exact same thing for the private plan, submit the requirement or submit the same paperwork to the private plan. The results could potentially be more confusing if we didn't do that. We'd have one set of timeframes for CTPL, one set of timeframes for FMLA. So we felt like at least keeping consistent is good, at least to start. And there always is the opportunity for, if there's some reason why the employee can't provide 30 days notice, those claims are not necessarily going to be denied if there's a reasonable cause for that. The next item was related to notifications of changes to the plan. Basically, the request was that we have an exception to the requirement that carriers provide notification to the employer of changes if it's due to a change in law or due to a employer initiated request for a change. We agree with the second part. If the employer is requesting that a change be made to their policy, they don't need to be notified of that change happening to their policy. They requested it. And then there already is an exception for changes in law where they're allowed to do it based on the law changing, not requiring the employer's consent or advance notice. Nevertheless, we always want all parties to be aware of what's happening, and we would prefer carriers tell employers specifically what changed in their policy. And based on the change, the reason for the change, the actual specific change will impact how that notification is given. But nevertheless, we always feel like everyone should be involved: employers, employees, and carriers. The next two items are kind of opposite ends of the same coin, involving how much time carriers have to pay claims that are approved. So the first one is from whether carriers had additional time when they've already approved a claim, but it's for a future date. They were asking if we could provide an additional 15 days to pay those claims. And we felt like that was too long a period of time. They've already gotten all the documentation. They've already gotten everything they need. They were just waiting for the leave to actually happen before the claim needs to be paid. And it didn't feel like the same period of time, 15 calendar days, should apply in that scenario as apply when they need to actually determine if a claim needs to be approved. And the claims are for a past date. Similarly, the request was that 15 days is too long a period of time, and that employees will need the funds faster than that. And our response to that was we felt like 15 days, particularly when we're talking about calendar days, is useful because of holidays. I'm thinking with Thanksgiving and Christmas, how many days we lose because of those, and New Year's. So that could be helpful. When it comes to intermittent and reduced leaves in particular, the verification of hours may not be as easy as just tell us how much time you took. There's a little more complication that happen after the leave is finally taken. And then it's pretty standard practice to use the same day of the week every time. So that may not always align with when the end of the leave occurs. And then, to be honest with you, the authority, the public plan, is paying about 10 days after the leave is taken. So, we pay on the second Tuesday following a week. That's about 10 days. So, asking carriers to do something significantly less than that did not seem fair. Next item was around when a plan terminates, a private plan terminates. We're asking for some data to be passed back to the authority so that we know how much time was utilized by employees, so that they don't get a brand new 12 weeks of paid leave allowance under the public plan, even though they just used all their 12 weeks, the quarter before the plan terminates. So when it comes to the information past the authority, we did receive a comment about they wanted to provide it potentially in hours utilized as opposed to weeks, because I think they felt that that's more specific, more exact, and weeks is too broad a category. However, use of hours is difficult because leave utilization depends on your employee's schedule versus the hours used, whereas weeks already takes into account. And additionally, weeks, they can use fractions or decimals to be as specific as possible. So we don't mind if you tell us that an employee uses 7.27 weeks. In fact, that's what we would like to receive. There was a request to make sure that we aligned the self-insured plan rules to the insured plan rules when it comes to transitions between one carrier to another, one TPA to another, a carrier to a TPA, or the public to private plan. So we did confirm that. And then we just added a note that if a leave lasts beyond the termination date of that plan, the original carrier is liable to continue paying those claims. However, that leave should never go beyond 12 months. If the leave goes 12 months, it should be refiled rather than extended. It almost becomes a new leave rather than an extension of the existing one. So just clarifying that when it comes to who owns that specific leave claim. I swear I'm almost done. The next item we received was around the method used for calculating paid leave allowance. As people know, there's kind of 4 mentioned in the FMLA statute, and there's 2 specific references to particular methods of calculating that formula in regards to specific leaves. So for military, it talks specifically about looking forward 12 months and allocating it that way. And for family violence, it talks about calendar year basis. So when it comes to the public plan, so outside this document, we're always using look back, even for those 2. We always use a 12-month look back method. Carriers on the private side and employers are allowed to use whichever the 4 they want when they calculate the allowance. However, even if they pick a different one for military caregiver and for family violence leave, they are allowed to potentially use a unique version just for those. So we clarified in the document. That was probably very confusing. I probably went through too fast, but just know that we made it clear that the allocation allowance method that is used will line up with what the statute allows employers to do. Prior earnings, there was a request involving for private plans whether they had to consider earnings from other employers when factoring eligibility or benefit calculations. We made it clear that when it comes to a private plan, the private plan employers are allowed to only factor in the earnings they receive from their own employer. They don't have the access to the DOL data that we do. It'd be much more difficult for them to do that analysis. So we made it clear that they are allowed to only consider the earnings they had from that particular employer, the private plan. Next few are all about appeals. One request was not to use the term appeal when we're not talking about appeals. So essentially what we wanted is when a claim is denied or is approved for less than what the employee may have expected, they can ask for a reconsideration. So on the public side, we do have that option available. And on the private side, we would like that option to also be available. It's kind of preventing them from going right to the DOL if that can be avoided. So there's kind of 2 processes, a reconsideration process and an appeal process. And the request was that the language reflect those 2 as unique options. We also received a request to ask every private plan employer to provide a contact person for the purpose of appeals, so that the Department of Labor can reach out to that person to gather any paperwork they need and have a response from them if there's any need for them to be there at a hearing or provide other response. In relation to this reconsideration versus appeals, this next request was involved making it clear that those are 2 separate things and the employee doesn't have to request reconsideration in order to request an appeal. So if they want to skip the reconsideration, they don't think it's going to be worth their time, they just don't want to deal with the carrier any longer, they can go directly to the Department of Labor. And then the next item on the list is similar, making it clear that in the initial denial letter, they need to provide the information that there is a right to appeal. So it's not that the information is provided after reconsideration because the employee may never ask for reconsideration. Instead, it's available at the moment of denial. The next item. Oh, this is a common theme that we did receive from the public and from the insurance industry. A request to have the program set up that private plans, actually employers will continue to pay wages of employees who are on leave, and then the private plans, rather than paying the employee, would reimburse the employer for payments they're already making. That's allowed, I believe, in Massachusetts and New York currently. However, we just didn't feel like the statute allowed that type of plan design. I think we're only allowed to pay employees, or potentially, if required by law, child support or something like that. I don't think there's an option for private plans or the public authority to pay employers as a reimbursement for continuing to pay wages. There was a request about the start date of the first report that's due about details of how claims are being paid and participation in private plans, just bumping it from April 1st to May 1st. So we agreed to that change. And then last but not least, there was a request involving employees who work for a private plan less than 2 calendar quarters, whether they can only consider the weeks that they actually worked when calculating their benefit and do a pro rata basis for benefits. If you only worked for 6 weeks for the employer, then you only consider those 6 weeks in their benefit period. And we did allow private plans are allowed to do that. So that was a whole lot of things. I've monologued for quite a while. Happy to take any questions, go back, provide clarification, or if you want to reconsider anything.
This is Daryl. John is currently not available, so I'm going to take over. And any questions for Michael? And great presentation, Michael. Okay, next, I think we go to Aaron for the board discussion and summary.
Daryl, I think we're good. Actually, John just did what Aaron was going to do. So what we need now is a motion to adopt the consolidated policy documents.
Thank you. All right.
You're welcome.
Seeking a motion.
This is Mike. Motion to adopt the policy.
Second.
I'll second it.
Thank you. Calling for a vote. All in favor?
Aye.
Aye.
Aye. Any against? Abstentions? Motion carries. Next item on our agenda is the registration and contribution portal project update. To Jessica, would you please provide the registration and contribution portal updates?
Absolutely. Good morning. Okay. So here are our program metrics as of yesterday. We have just shy of 123,000 registered businesses. Contributions received or in transit, $300,127,058. We are at 438 approved private plans, and of those, 49 are self-insured. 254 open contact us inquiries. Since September of 2020, 23,797 inquiries have been resolved. And we currently have a total of 882 TPAs or tax accountants registered And you can see the breakdown there is 428 TPAs and 454 tax accountants. In terms of our activities for the portal on the registration and contribution side, we continue with production support. The Q3 payment processing is complete. Identification of professional employer organizations for claims processing. The development of the TPA amended return process, analysis of payment compliance, and analysis of employee overpayment. On the benefit and claim administration side, we are working on enhancing the website content for claims, testing interfaces with AFLAC, testing the AFLAC Human Resources portal, integration of the benefit support to the contact center, and analysis for coordination of benefits with the Department of Labor. And then with that, I will segue into our outreach and engagement updates. So in terms of our website performance, we saw a pretty substantial spike in the month of October. You can see our total visits jumped from just about 45,000 in September to over 103,000 in October. And that came from a total of nearly 61,000 unique visitors. So this is a great indication that as we're getting closer to claims, more and more folks are visiting the website to get information. And we also see that in terms of the top pages visited in October, with the #1 place folks going to is the employee landing page, #2, the employer landing page, and then #3, the new prepare to submit a claim page. And then in terms of the breakdown, it was 47% of our visitors were new and about 53% were returning in the month of October. In terms of our email deployments, our open rate jumped up in October to 21.5%. So of the emails sent out, we had nearly 84,500 opens. So again, as we're approaching that benefits implementation, we know people are paying more attention to the communications that we're sending out. I wanted to share with you some additional media presence. We have here on the left side of the screen, this is an ad that we've placed in the White Eagle newspaper, which is a Polish language newspaper. And then on the right, and I want to thank Adrian for making this suggestion in our committee meeting, we are placing some ads in the Inquiring News. And so you see there circled on the right, the ad that just went into this, this week's publication. I also wanted to share with you, as I think I mentioned last month, the Connecticut Construction Industry Association is featuring an article on Connecticut paid leave in their upcoming fall-winter edition, which goes out to about 4,000 members. And they will also be sending me a link to the digital edition when it comes out in December, which I will pass along to you all so that you can read it. Happy to announce that our buses are now live and roaming the streets of Lower Fairfield County. Here are some pictures of the 2 different creatives that we have out there. And there are 12 buses in total traveling between Norwalk and Sanford Greenwich area. I also wanted to make a note that we are going to be introducing some additional messaging in advance of December 1st, where we're really encouraging folks to plan to submit their claims through the online portal. And in order to prepare them for that, we've created a tutorial video walking them through how to create the Connecticut paid leave account, which of course involves creating a ct.gov account. And so we're also updating some messaging on our website, our radio messaging, our social media, to encourage folks to go and create that account so that they will be ready to use the online portal on December 1st. We're doing this in hopes of cutting down on phone calls to AFLAC in those first few days of claims acceptance. I also wanted to acknowledge that our engagement manager, Nancy Barrow, has been working really hard in getting us in with some different sources to help disseminate our information. And she was able to make a connection with the Connecticut Association of Public School Superintendents. And they featured some information about us on their website. With a link to some of our upcoming webinars. So that was also something we had discussed at our committee meeting, and how we could get in with boards of education, et cetera, to help get this information about paid leave out to students and their families. And so I think this was a great way for us to start to make inroads there. I also wanted to share with you that we are about to launch a digital video campaign. And I would like to play it for you. So hopefully this is going to work. I believe I do have the sound sharing enabled.
In January, most Connecticut workers will be eligible for up to 12 weeks of income replacement to take time off to care for themselves or a family member who is seriously ill, or for certain other reasons, such as bonding with a new child, caring for an injured military family member, being a bone marrow or organ donor, or addressing family violence issues. Connecticut paid leave means you can care for yourself and your loved ones and have income security. Applications for benefits available in December. Learn more at ctpaidleave.org.
Okay, so that campaign is about to go live. Excuse me, I just want to put it back into presentation mode. And we also have a version of that in Spanish as well that we'll be running. We have also been focusing on military outreach. So we've created some new collateral pieces in English and Spanish addressing military caregiver leave and qualifying exigency leave, and discussing the eligibility criteria both for paid leave benefits and for job protection. Again, Nancy's been working really hard in our outreach efforts, and she was able to connect us with the Army Recruiting Office in Hartford. And she and Aaron will be going up there next week to address a group of about 30 active Army members and share this information with them. In our committee meeting last month, I also shared a recap, an overview of the media plan that we currently have going on, and it was asked that I share that with the full board. So I'd like to just give you an overview of all of the media that we have going out right now. Radio, we have 17 English language stations running our commercials and 8 Spanish language stations. Over 4,000 commercials will air, plus additional public service announcements. Andrea has already completed or been confirmed for 10 interviews, and there will be more coming. And all of the radio stations that we're working with have also placed banner ads on their websites for us as added value. In terms of print, we're using print to reach some of the more diverse audiences. So we have print ads in La Voz Hispana, which reaches nearly 15% of the state population, over 500,000. The White Eagle, which I showed you an image of, which reaches over 8% of the state population. And then the Inquiring News, which has a circulation of about 55,000 weekly. In terms of outdoor, I know you saw our billboards that Andrea had sent out via email. So those billboards, we have they're digital boards, which are rotating with coverage between Hartford, New Haven, and Fairfield counties, and they deliver over 5 million impressions per week. We have the buses. As I mentioned, there are 12 of them total, and they are covering Lower Fairfield County from Norwalk to Greenwich, and those will deliver over 5.4 million impressions over our 12-week campaign. The digital video that I showed you is part of a larger digital campaign, which will include static banner ads, video pre-roll, which are ads that you would see before, for example, watching something on YouTube, streaming audio. So that will reach folks when they're listening to Spotify, iHeart, TuneIn Radio, as well as what's called CTV, connected TV, or OTT is over-the-top ads. And that's essentially a fancy way of saying streaming content when folks are watching long-form programming through a streaming service as opposed to traditional cable service. All of these ads are going to be demographically and geographically targeted and will be in both English and Spanish. And then lastly, this was another recommendation that had come out of our committee meeting. We are going to be placing some ads with Metro North in the rail stations. So there will be 23 units running over an 8-week duration. And we've strategically chosen the stations, which will include New Haven, West Haven, Milford, Stratford, Bridgeport, East Norwalk, South Norwalk, and Stamford. And lastly, we have not slowed down with our events. Nancy and I were down in Bridgeport Halloween weekend, October 30th, for a huge event with WEZN Radio. We were able to get information about paid leave into the hands of over 2,500 folks who came through with their children for that event, which was great. This weekend, November 14th, we will be both in Lyme at High Hopes Holiday Market. High Hopes is an organization that assists folks with developmental disabilities. So we thought that would be a great place to help distribute information. And we'll also be at the Hartford Healthcare Mystic Half Marathon. On November 18th, we will be at an event called the Big Connect with the New Haven Chamber of Commerce, which will allow us to connect with businesses. And on December 10th, we will also be, again, working with a radio station, WPLR, for a massive toy drive that they'll be holding in New Haven. And with that, I'm happy to answer any questions that anyone might have about my presentation or our outreach efforts.
Thank you very much. Wonderful, Jessica, wonderful update. And Andrea, hopefully you're staying strong with all these interviews and promotional opportunities. It certainly is a tremendous effort, and we appreciate you there as well. The next is our committee reports on the Policy and Personnel Committee. The Policy and Personnel Committee met this month, November 2nd, and we reviewed provided comments received in connection with the private plan policies. The next committee is Outreach and Engagement. To Jessica.
We did meet in October, and I have included everything that we discussed in the presentation that you just saw.
Thank you. The next committee is Finance and Audit. To Paul.
Thanks, Daryl. So I think the agenda this morning gave you a flavor of what we discussed at our last Finance and Audit Committee. We reviewed the audit report issued by Markham, and I want to thank Andrea, Dave, Locke, and the entire CTPL team for producing such a strong and clean audit covering the first 18 months of the authority's operations. And we also had a presentation on the actuarial analysis that we heard earlier this morning. And apropos of John Scott's comments, had a discussion about some of the policy levers available to the board in the future, both on the benefit side and the contribution side, once we have some actual experience under our belts and then can apply that experience to projections for the future. So with that, I think we're ready to go through the financial reports for the authority through the month of October. So I'm going to turn it over to Dave Marcone for that discussion. David.
Thank you, Paul. Appreciate that. Good morning, everybody, and thank you for joining us this morning. I'm going to share my screen. You should see the agenda. Let's look at some numbers. We're going to start talking about the month of September. As we reported to the Finance Committee a few weeks ago, for the month of September, the authority expended $879,000. For the quarter, we were ahead of budget by $270,000. During the month of September, those expenditures included $328,000 for project costs related to the employee contribution system, $304,000 for salaries, benefits, and taxes, $120,000 that we pay the contact center for keeping in touch with our employers and answering any questions they have, and $76,000 on the outreach efforts that Jessica had described previously. Moving on to how we're doing cumulatively, we are at $16.7 million to date of spending. 3.6 million of that was in the current fiscal year. Again, we are ahead of budget by $15.3 million, and that's primarily driven by the less than expected monies that we're using on bond funds. In terms of what we are spending it on cumulatively, it's similar to the categories I had mentioned before. $8 million on the employee contribution system. There's $1.5 million we spent with AFLAC to implement claims and benefits. $99,000 on the chatbot initiative. $3.1 million for salary, benefits, and taxes. $1.6 million for our support teams, including our friends at United Way for the contact center. $753,000 for post-production support and $483,000 on our outreach efforts. Since a lot of the spending does come from bond funds, I'd like to give you a brief update on that. We still have $12.2 million allocated. We have spent $9.7 million through September on the contribution system and the benefit claim system, and a little on chatbot. We do have another $109,000 in the hopper to be paid for Slalom for the employee contribution system. And we do have $450,000 set aside for the Department of Labor for the appeals administration system they're building. That is our share, since they will be taking the appeals on behalf of the paid leave authority. That, including all that, that leaves us just under $2 million left of bond funds that's been allocated, but hasn't been specifically earmarked to be spent on anything specific yet. That's the money going out. Let's talk about the money coming in. September was a light month, relatively speaking. We'll talk about the heavier month in a second. September is a quarter end, but most employers, and especially TPAs, like to pay in the grace period. That's the month after the quarter end. So for September, we did get almost $975,000, earned a little investment income, and paid our what is now regular monthly payment to pay the seed funds back of $319,000. That does leave us about $198.5 million in the fund as of the end of September. Cumulatively through September, we have collected $206 million, which is more than we budgeted, as we did budget very conservatively. But we are on track, we believe, to collect about $400 million into the fund by January 31. As Jessica had mentioned, we're going to jump ahead to October. We have collected over $300 million through November 8th. Through the end of October, it was a little less than that, $299.3 million. Like I mentioned, everybody likes to pay the last month, and everybody likes to pay the last week, and everybody likes to pay the last day. As a matter of fact, on the last business day of October, we collected, or it was in transit, the amount of $72.5 million. For the third quarter, the collections were $95.6 million. That is a little less than prior quarters, but not surprising, as the second and third quarters of the year, there tends to be a lower wage base in those quarters than the first and fourth quarter. So we do expect a little bit of a pickup in the fourth quarter. And like I mentioned, we still do expect to be on track for $400 million of contributions collected by January 31st. In terms of money that was expended in the month of October, that was $1.6 million. Of that amount, we spent $972,000 on post-production support. There was some back billing and payments on that for a few months. Salaries, benefits, and taxes were $310,000. Our contact center was again $120,000. Development work on the employee contribution system was $109,000. And those were the major items that we spent money on in the month of October. That's what's going on in the authority from a finance standpoint. Does anybody have any questions? Okay, thank you for your time. And since tomorrow is Veterans Day, I just wanted to thank anybody on this call. I know there's at least one for your service to our country. Thank you.
Sorry. Thank you, Dave and Paul. The next item is our CEO report with Andrea.
Morning, everyone. I know our meeting has run long today, but I think we had a few important things we needed to address. So I appreciate your patience, and I do have a few more things that I'd like to mention. First is that there are 16 days left to go live. It doesn't seem like December is that close, but it indeed is. And we have a countdown that we have every Friday at our staff meetings. Everyone's so excited when I read how many days are remaining, but they're doing well. So we're excited about that. I wanted to let everyone know that all of the AFLAC and the CTPL staff have been hired, onboarded, and trained, and they continue to be trained so that they can be fully prepared for December 1. We have given, and I was just asking Amber to give me the number of webinars that we've given since September. Just let me check here again. I think she said the number was 31, so that's right. So we've hosted 31 webinars on one series is entitled, Hey, do you have a minute? And that's when it's designed for when employers have to encounter someone who comes and knocks on their door to say that they want to take leave. And then we have another from business owners, and we have another series for workers, which we Jessica just gave one this morning at 8 o'clock. So we're continuing to do all of that outreach and engagement. And I think we had 30 altogether. We did one this morning, we'll be giving 2 more today, and we'll probably schedule another series of 6 to 8 more before the end of December, because there's just a demand for people to really know how the process is working. I did give a live presentation at the CBIA at their employment practices seminar, and we will be offering their members another webinar because there were so many questions that could not be covered in the time period that we had. And you know, the CBIA is an important partner. They have lots of small businesses, so we want to make sure that they are properly prepared. And I think it was Dave that mentioned the appeals process. So again, I want to thank the Department of Labor, and we've had enormous cooperation and collaboration in getting that done so that the online appeals process is scheduled to be delivered and live by 12/20. And as we sit here today, we are still online and on track to meet that date. The last time that the board met, we asked for your permission to continue our negotiations with United Way to renew the contract. I'm happy to say they were delighted to be able to continue to work with us, and that contract has been executed as of October 29th. So they wasted no time after the last board meeting and getting the contract reviewed and signed. So it is a 1-year renewal with an additional 1-year renewal option, which is what the board gave us permission to do. And then I'd like to turn my attention to our team. And I know, Paul, that you'd said this, but I really would like to give kudos to Dave and Locke and Amy and everyone that's on the finance team, because the audit results were just really outstanding. And that has everything to do with how well they maintain the resources that we're entrusted with. And so I really want to thank all of you for the extraordinary work that you've done and continue to do. And I don't see Amir Khan on our call, but Amir, I would also like to recognize him. Amir is the person who's leading the stand up of our benefits effort. He has onboarded some extraordinary team members, some of whom are here today, Crystal and Omar. And I forgive me if I don't call out everybody. I see Yvette as well. They come to us with really fantastic backgrounds. We couldn't be happier to have them. And that includes John Simonetti, who came to us from the Department of Children and Families, and he is leading our quality assurance efforts. John has already met with a number of other state agencies and private providers as well, so that we could get a full understanding of how and what we should be measuring to hold the TPA accountable for the work that we're hiring them to do. So I want to thank you for that and the work that's being done. And that is really what I had to report today, is that I am at every meeting just extraordinarily proud of the work that our team does. Not sure how they do it, because there are only, this time last year, there were 10 of us. And now there will be 22, but there's still only 22 people that do all of this work. So I'm just extremely proud of them. And I like to always give them an opportunity to be acknowledged publicly for the work that they do. And that ends my report, unless anyone has any questions for me.
Thanks again so much, Andrea, and the PFML team. Next on the agenda item is old business. Any old business? Next is new business. Any new business? And finally, our adjournment. May I have a motion?
So moved.
Second? Thank you, Michael. All in favor?
Aye.
Aye.
Aye. Any against? Abstentions? The motion carries. Everyone have a great day and week. And again, to our veterans, happy Veterans Day tomorrow.
Thank you.
Thanks.
Thank you, everyone.
Thank you.